And we're back.
That's it, REI Hot Seat. But this is our 4th episode at the new studio.
New studio.
And Dave makes me say this every time, so it's big new studio.
Yes.
Big new look, big new deals.
I love it.
Welcome.
I love it. So what do we have, Jake? You've got some stuff
I
to chat
can
about.
fire it off today. So today we're going to be just talking general market update, right? So we always like to do these episodes every once in a while. Yes, deal review is fun. People want to get in the weeds. But then at the same time, I think it's important to say, well, what's actually happening out there?
Yeah.
We've had that question a lot from some of our trusted clients just saying, hey, you know, everything's happening so quickly. Where are we at, right? What's the sentiment in the market? I think is a really good question to start with.
Yes.
Dave, I want to hear your sentiment. I'm going to talk about mine, and then we can talk a little bit about stats.
It's good because we didn't coordinate, so I'm curious if our thoughts on what's going on is aligned.
I'm putting you on. That's why it's called hot seat, man.
Yeah,
putting you in the seat.
We're in the seat. So this is what I think has been happening is we saw a lot of inventory hit the market on and off, and the prices sort of got pushed down. There was power of sales that came out, and there was really, really compelling deals. I think we've seen a bit of an increase from those prices and a lot of buyers coming back. I think a lot of that inventory got gobbled up. There's a lot of buyers back. Not, atypical to this type of time of the year, but also with what's going on. So when you're seeing these deals that we keep showing you guys, 85% LTV direct to CMHC with lift, there's an abundance of buyers that have capital that see, hey, these deals, it's really hard to miss on a direct to CMHC deal like that. So that we're seeing that get gobbled up. What we haven't seen is too much of an increase from that point in price. Like we're not watching prices continue to climb back to where they were. So if we sort of mapped it out, it's at a lower price point, but the inventory is being consumed. Right. So it's a great time on both sides of the equation, which I know sounds salesy, but we're seeing a lot of transactions, good deals.
Yeah, and to that point, like we have some sellers that we've just agreed, hey, we're going to revisit your building every 6 months and reevaluate it every 6 months because these are sellers that don't necessarily need to sell, don't want to sell for the price that the market's going to bear. So we've just continued to push that down the road. Yeah. Let's see what happens in 6 months. So it's a fun exercise to do with some people. From an
inventory perspective. So I want to list my property right now. We get this question too. It's mid-November. Do we list it? Do we wait?
Yeah, so it's interesting. So I'll just start at the top, and I'll answer your question as part of my sentiment in the market. So I mirror what Dave's saying. There's definitely seems to be action in the market. If you're following the residential single-family home market, it seems to be quite stagnant. Yeah. So we're getting a lot of these people talking to us saying, "Oh my gosh, commercial must be bad as well." And we say, "Well, no, it's actually fairly busy, but it's busy for specific assets in specific markets." And I think that's the key note here. We've looked at stuff in Hamilton that seems to be sitting around. Good assets, right? And just they're having a bit of a tough time there. Niagara region having a bit of a tough time. But you're looking at Oakville, Burlington, Mississauga. You're looking at Kitchener, Cambridge, Waterloo, Guelph, London even, for example. Like these are markets that are, in my opinion, quite attractive. And we're seeing quite a bit of action in these markets. Outside of that, who's buying right now, at least what I've seen, and Dave, you can perhaps comment on this, but the buyer pool seems to be more sophisticated, seems to be more institutional, family office, REIT, whatnot. And my rationale to that is I think they've been, it's really flipped compared to what we saw 2-3 years ago, right? And it's just, again, it's the fear greed index, as you put.
I love that.
Right?
Yeah,
and so these guys, the smart money, fiscally
responsible?
Fiscally responsible.
Is that what you're going to say?
Yes, thank you. These guys sat on the sidelines very patiently over the last 2, 3, 4 years and did not buy in the market when everybody else was buying in the greedy times, right? Now we're in the fearful times and we see these people coming to market, right? All the big guys are calling saying, hey, we have capital we need to spend before the end of the year. Yep. Like we're bullish on this, let's go. And so that's the type of asset class we're seeing get gobbled up quite quickly. Multiple offers, bid dates, etc. We're the small guys in the equation still, and I don't want to say, that it wasn't smart money, but just some people that got caught up in the rush, right? In the times. And listen, I'll put my hand up too. I got caught up in it, right? We all did. And so I think these guys are, on the whole, I think they're over leveraged. I think they're tapped out on capital. So I think right now they're now sitting on the sidelines saying, let's just see what happens. Let's feel this out.
Yeah, I would agree. I think there's a lot of, 75, 80% of the buyers I'm working with right now are returning, right? So even if not institutional, own a few multis, because there is that fear. But the ones that are newer, that are looking and have transacted or conditional right now, you get almost overly excited for them because it's like, I know it's difficult to buy in this fearful time, but again, if it's sending it to CMHC and it's the metrics are there, it's so hard to screw up.
Basics,
so in 3 years, 4 years, 5 years, whenever, and you already have a deal, what an exciting time. It's so obvious to say, you just follow kind of what the bigger institution money does. That's on everything. That's investing. That's buying real estate.
And it's not
just
as
hard.
easy. Yeah, it's not as easy as it
It's
sounds,
so easy to
right?
sit back and look at it and say, of course I'm going to do that. If you're an index, when it's fearful, I'm going to do it.
Right.
Except you read the news, you watch the condo market, and you go, oh my gosh, should I buy a multi?
Yeah.
But the big boys are doing it, big boys and girls.
And I think that to that comment, it's also dictating what assets are selling quickly, right? We know development is slow.
Yes.
Period. Right. And so when Dave was saying earlier, talking about the power of sales, right, and things like that, we're seeing a lot of that in development. The development market is so challenging to put value to properties right now because what is selling is power sale, receivership, et cetera. And what's not selling is the people that don't need to sell, right? So it's so challenging to price these assets out. So for development, that's one thing. We'll put that in its own little silo. Then we have, the commercial retail market, which is, I think, just as hot as multifamily, if not maybe even hotter.
Which surprises a lot of people.
Yeah.
Right?
It's fundamental real estate, right? Like it's they're not going anywhere. The tariffs don't really affect the microeconomics of a retail plaza with a Max Milk and a veterinarian clinic, right? So it's like these are neighborhood commercial uses. They're stable. They're not going anywhere. These are important to these neighborhoods that are around. So stabilized, market. Retail, I think, is very important. So that's a hot market. We get a lot of people every day. I get at least an email a day saying, you got any retail plazas?
Very busy.
Multifamily is doing quite well. Again, larger assets is what I find, right? If we talk duplex, triplex, fourplex, fiveplex, I think those are having a very hard
Very
time
rough time
right now.
Yeah.
Right? We've seen it. We've listed a few and we've experienced it ourselves. So that's kind of a stagnant market. The cap rate needs to be outrageous for people to bite. And again, I think that's because of who the buyer pool is. Right, the REITs, the family offices are not buying the fiveplex.
That's exactly it.
So it's these larger assets. These call it 20 plus unit. Right, even the 5s and 10 or the 6, 7, 8, 9, 10. They're moving quicker, but still not at the rate that the 20 pluses are selling at.
The other thing that's been interesting is the larger institutional money, even mid-sized institutional or bigger groups. So think 75 plus units. I've had this on 3 different occasions. Hey, show us stuff 30 and above now.
Right.
And you're going, well, why would they change their buying criteria? Because the metrics are so attractive to them, and it is making a lot of sense that they're going, we actually can't buy enough right now. So they're actually creeping down into that space, and that's why these deals are sort of happening.
And then, so I guess future, right? Talk about that quick. So based on the comment you just said, do you see building values, do you see cap rates start to compress, right? Because what you just said, like that's basics of supply and demand economics, right?
I
like
know,
it's
and they're not building, like people aren't really building a lot more buildings. So I think so, would be my guess.
Right.
But not to the degree and the speed at which we saw it before, because you got to think, if the metrics start changing too much, if interest rates stay the same and bond yields stay somewhat stagnant, I don't think there's a lot of people that are going to go buy a direct to CMHC deal with 60% loan to value. 75 from 85? Absolutely. And in fact, we're kind of seeing that. 85 used to be the across the board. Now people are doing it at 82. And I'm sure 80 is coming because you're still buying a cash flowing deal with lift at 80%.
Well, there was a period there where people were saying, I'm only buying 95% LTV, right? And
whatnot. MLI Select, right? So I think so. I just don't think it'll be as rapid and aggressive as we've once seen.
Yeah.
But it'll be really interesting because December sort of typically slows down. Be really interesting to see how much inventory is going to come to light Jan and Feb, and when it does, at what price.
Yeah. I'm really excited to watch that. I'm to see what happens, because I agree with you fully, right? I do think prices are going to start to creep back up. The demand's there. The interest rates are coming down, which helps, right? So as interest rates come down, that means cap rates can slightly compress and the deals still make just as much sense.
Yep.
Right?
Yep.
It's just they slide together.
Yeah.
But yeah, I don't see 3 caps being sold anytime soon. And I know a lot of people out there are hoping for that, right? Hey, I need my building to start appraising, which it once did.
Right.
And I think we're in for a little bit of a long journey for that, if it even ever gets back there.
Yeah.
Right? Because very honestly, like 4.75, 5 caps, like these are sound numbers.
Fundamental.
Like it's not, with interest rates sitting around that, call it 4 to high 3s to 4 with a CMHC deal. Mm-hmm. These are normal interest rates, right? And we just got spoiled by these 1%, 2% interest rates we had over the past 4 years, 5 years, which now we're paying for it, right? And look what it's done to the economy and to building owners and business owners, right? So it's tough. It's a tough go. Yeah. But I do think we're in a better buying market, definitely, and I think the sellers' expectations are going to have to come down because it's not catching back up.
And I think they have the ones that sold, or just properly aligned pricing, and then to your point, there's some dead inventory, we'll call it, where the sellers have just kind of put their stake in the sand and they're not moving off it.
Yep.
And we'll see. So
see where it goes. Well, I think that's a really good summary of what's happening, at least in our opinion. Right? Yep. Everybody's going to have their own opinion, but this is what we're seeing in the market. Remember to like, follow, subscribe, click the bell if you want notifications, and most of all, sign up to the Insider. Let's get you into the list. Let's talk deals. Let's get you the deal of the week, the deal analyzer, all the good stuff that's in there, and then have a call with us and just talk about what are you looking for? Why are you watching this episode, right? Yeah. What's intrigued you? Do you own? Are you going to buy? Do you like watching us? Do you just think Dave's good looking? What is it, right? And then from there, we'll digest that down, get you into the system, and then we can have those follow-up calls and start sending product your way. So,
and the last piece would be fun to send this back to us in a year, and then the comments people say like, this didn't age well, or this aged well. Be really interesting.
Listen, I'm sure we got a bunch of episodes that are just our predictions are off or wrong.
I feel pretty confident in it, so this will be a good one. So
let's go from there.
Appreciate it. Thanks for following.
Guys, thanks.